Hi everyone, welcome to Single Value. So today we're going to talk about Upstart. Upstart is a company coming onto the public markets on the 16th of December, same time as Context Logic, who does the Wish app. So potentially a lot of people will be focused on Context Logic, and Upstart could come under the radar. So Upstart is a company that specializes in artificial intelligence, and they use this approach for personal loans, and they've actually found it gets better results. But we'll go through those results right after this. So this is a company coming onto the markets at a $1.6 billion valuation. Their share price is looking about $20 to $22 per share, unless that changes closer to the IPO date, as we've noticed with a lot of IPOs where demand is extremely high. So with this company, they have about 3 million shares that are being sold by existing shareholders, and then 9 million new shares will be issued to raise capital. This is a company that is still majority owned by its founder, Dave Gurwad, who owns 22.1% of the shares, and overall the insiders own about 28.3% of the company. So that kind of gives you a good idea of, that management is, they do have skin in the game. They have a big incentive to make this company work, and the valuation in my view isn't too high, but of course we'll go through the revenues, and then you can decide it by yourself as well. But first I want to go through why this company stands out in terms of their AI approach. So as they put here, affordable credit is inaccessible for millions because existing systems fail to accurately quantify risk. So we're dealing with a system that focuses on the FICO score, which was invented in 1989, and they found the score just doesn't really take into account how creditworthy someone really is, because everyone's different in terms of their personal circumstances, and it is actually based on the past rather than the future, whereas their system actually tries to focus more on the client's future and their ability to pay based on that, whereas your past credit scores are based on your past, and that could heavily go against you. And I've actually found only 48% of Americans who actually have access to prime credit in the current model, whereas we have a situation where 80% of Americans have actually never defaulted on a credit product. So all of a sudden, with an AI approach, we can have about 80% of people potentially getting prime credit, but in the current system, we only have 48%, which means if a lot of people don't have prime credit, then they're actually perceived as a higher risk. They get charged a higher rate, and also the people in the prime credit situation also get charged a higher rate because the bank is trying to balance their risks. In event the ones with a low credit rating defaults, they're going to use their prime credit clients to try to compensate for that higher risk. So in that system, everyone ends up paying a higher interest rate. And also not as many people get loans as well because they're seen as more risky. But whereas they've actually found they can actually, based on their system, they can actually give out more loans and actually give those loans with lower interest rates. So think about how much better that system would be. And for me, I find that a very, very compelling method of doing things. The one risk about this bank is it currently has about 10 banks that it has as clients, but one of them takes up a surprisingly large amount of their revenue. So as they say, we had 10 bank partners in the 9 months ended September 30th, 2020. Cross River Bank originated 72% of the loans facilitated on our platform, and fees received from Cross River Bank accounted for 69% of our total revenue. So you can kind of see, like, Cross River Bank takes up a lot of their revenue, and potentially it's a risk to them if Cross River Bank ever decides to leave. So the current terms on Cross River Bank is they started in 2019, and they have a 4-year term in terms of what they've agreed, and with further renewal of 2 additional years. So after this year, they still have 2 more years in their agreement. So I think that's enough to, keep the company stable, that their biggest client won't be leaving them for about 2 years. And also in that time, they can find more partners. But it also gives you insight into their future as well, because if one bank could actually give them so much of their revenue, potentially if they can sign a bank of a similar size, then potentially they can easily double their revenue very easily. So there is a good side of this, and there is a bad side of that too. Let's go and analyze their revenues. So as you can see here, the revenues have been increasing at a very nice rate. In 2017, the revenues were 51 million, that increased to 88 million, and in 2019, that basically nearly not quite doubled, but close enough to $159 million from that 88. So, talk about really impressive numbers from that time. Though they were quite badly affected during this year, so they didn't grow as quick as they did last year. Based on a 9-month kind of 9-month performance, the 2019 performance was 98 million, and that increased to 144 million for this year at the end of September. So the performance was still quite good, but wasn't as great as the prior year, though they did have a down quarter. I think it was about quarter 2 or something, where the growth was actually very minimal. So they did have a big impact by that quarter. If not, their growth could have been a lot higher. So I kind of think next year's their growth is going to be higher. And I also think, based on that performance, with that one quarter that didn't perform too well, it means the numbers are lower, and potentially allows you to buy this company at a much cheaper valuation than if their growth rate was quite high. So potentially that's kind of like that hidden part that not a lot of people are going to notice. So we're looking at some decent growth in their revenues. And in terms of how they grow their revenues, they have a part down here. They have referral fees. So basically, they implement their AI system in their banking partner's website, or you can actually get a loan from them on their main website, which is at upstart.com. And then basically, they'll refer their bank partner to you, who will make the loan. So this company never really makes the loan itself. It's more like a origination system, kind of very similar to Rocket Companies. So they'll make the loan, and the banks will be the ones that fund it. So the risk to the company in terms of loan defaults isn't actually that big of a risk to them as a company, because it's the banks that really take on that risk. They're more the ones that, if they can actually approve more loans, which their system actually is made to do, because they've actually found they can actually assess people more accurately and provide more loans. So they actually end up with a system where they can actually gain more referral fees. So referral fees are paid by bank partners, and it's about $400 to $500. And platform fees are also paid by the partners, who pay about $200 to $300. And in their servicing fees, which is 0.5 to 1%. And this is for the banking partners or institutional investors who buy the loans. So now that you've got a good idea of the breakdown of the fees, so we have referral fees. So this year, for the 9 months, it was about $80 million. And this was quite a big growth from the 56 million. So you can see that the referral fees part is actually quite large for them. And it means they're making quite a lot of loans. They do have platform fee as well, which was 42 million this year, increasing from the 32. And their service fees went from 9 million to 20 million. So overall, the performance of the company is doing very well, and this is based on 10 banking partners. And if they can perform better in the future, They could easily just basically sign another big client, and then all of a sudden their loan kind of referral fees are going to increase substantially. So I think their potential is really based on the size of the banking partner that they can sign up. If they can sign up some really big banking partners, then potentially their referral fees will go through the roof. And yeah, I think the company is basically still in its infancy. It is probably chose to come onto the market quite a bit earlier than most companies would come to the market in terms of how developed it is. I think it's past that proof of concept. It's kind of in that phase where it's kind of scaling quite well, but it's not reached that point of maturity where it's kind of got a lot of clients, and where it's got a lot of stability and consistency. But I do quite like a lot of things about all the things in here. The one thing you probably won't like as much is that one of their clients takes up over half their revenues, but that client is signed on with them for at least the next 2 years, so the risk of that isn't too bad. So yeah, I'm looking at this company and I think there is certainly a lot to like about it. So yeah, definitely let me know what your thoughts are on this company. We can also look at the history of their milestones. So in 2014, they did 35 million in loans, and this was the first time they were starting with their Upstart powered loan originated by our first bank. In 2015, they did 280 million, which is a significant jump. And this was their first AI-enabled loan trained exclusively at Upstart data. So as you can kind of see, AI, the longer AI does this, the more data that goes through the system, the better it gets. And as we see here, 2016, they did 568 million, and they did their first fully automated loan from application to funding. And in 2017, $1.4 billion, reached 1 million repayment events on their platform, received first no action letter issued by the CFPB. 2018 did 2.9 billion in loans. Majority of Upstart powered loans become fully automated. So that's the kind of key for this company. It wants to fully automate these loans where you apply on the website, the AI works it through the algorithms, and it can come up with a decision basically nearly instantly, if not within a day. So yeah, like the speed that it decides the loans and accuracy is what's really, really interesting about this company. 2019, they did 5.6 billion in loans, reached 5 million repayment events, first 1 billion quarter of transacted loan volume. And we bring it to this year, 2020, which was up to the year end, up to end of September. They reached 9 million payment events, and they did their first Upstart powered auto loan originated. So yeah, like as this company continues to build on their current system, they get better at what they do, and yeah, they start to look like a company that is very, very interesting. And I think they're going to be the future of how loans are done, because right now, if you have someone who basically applies for a loan and they go through a person, the cost is actually more. That person can't actually judge that person accurately enough, and hence why they rely on that score so much. Whereas this company is proving otherwise. As they put here, they have 15 billion sales of performance data, and they've done 622,079 loans transacted on their platform. There is a 70% reduction in loss rates. So yeah, no, those are incredibly good metrics. 10x increase in conversion rates since inception. 70% loans fully automated. 3 of the 4 last quarters are profitable. So that's also one thing I really like about this company, that that the loans are actually yeah, like the company itself is actually profitable at this stage. And I think that really provides a lot of security for the company going forward. So as we see here, out of the 144 million, 4.9 million is profit. And whereas the prior years, they were all loss-making years. The comparison from last year was 6.5 million loss. For this year, it's 4.9 million in profit. And I think as the company goes on forward, the margins will be incredibly good. The company will make some super profits. Like, you only have to look at rocket companies who makes a lot of loans. They're doing in some extraordinary numbers. They literally grew from several hundred million in profit to making billions in profit within a year. So I kind of see the same thing with Upstart, where their profit numbers can grow dramatically the bigger they get and the more they can prove their product. Because currently it's about proving their products in the small banks. Then as they go, they can actually start proving their product in larger and larger banks, because they start to build trust, they start to build a track record. And when they get to that stage, this company is going to be immense. It's going to be so large in size. You're going to be wondering, why didn't you invest in this company earlier? But of course, it's a company that's you're looking at in the long term, because you don't really get to execute these contracts with banks too quick. Banks will evaluate you in every single way. It will be a time-consuming process at the start, because at the start, there's so much to just kind of filter out and to do your due diligence. You're not going to let an AI system start approving your loans without knowing that the system works. So there will be a trial phase as well. But if you're willing to hold this company for like at least 1 or 2 years, I definitely see a significant upside, especially as the company has really proven what it can do. And the bigger the partners that can sign up, the more incredible the growth of this company will continue to be. And since their margins are actually so incredible, they're going to be an incredibly profitable company like next year or the year after. Like, if they can do 4.9 million this year, I definitely can see them, if they can keep up the growth rates, they can well go into the tens of millions next year. And who knows what they can do a year after that. They just have to consistently sign up more partners, because their loan system is proven to work. They just have to sign up more people, more banking partners, since they're the ones making, they're the ones that have the loans going through their website. And the more loans the system makes, the more money this company makes. So this company essentially is a money-making machine that just has to be plugged into a bank's website, and they earn an abundance of revenue. So yeah, definitely a company that's on my radar. I'm watching the IPO. I definitely want to buy some shares if the price is pretty reasonable, which I think the 1.6 billion is pretty reasonable. I see this company easily being about 2.5 to 3 billion in the very, very short term. And in over the longer term, I can see this company going to anywhere between a 4 to 5 billion valuation within a 12 to 18 months. So I think the upside is quite incredible. If they can sign the right banking partners, I think the future is really good with this company. Until then, let me know what your thoughts are, or if you have any questions, just post below. Until then, good luck investing, everyone.